This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth.
All right, welcome to the Realize Your Wealth podcast. Looking forward to getting in things today. We're going to do a little bit more of a dive to what to look forward to and what to expect in the market going forward. And what my thinking is, and when we're looking at markets going forward out into 2025, is to expect the unexpected. So looking forward to diving into things today, Greg.
Yeah, it's going to be a good one. Like 2024 on the whole was a good year in the markets. You kind of had that second leg of the recovery. 2023 was good. 2024 we kind of saw that continued strength, but there's a lot of things on the horizon in 2025 that I think we want to unpack and we want to get into. And the one thing I'll say, it's this time of year, end of the year, where a lot of people they're out there, they're making predictions on what's the S&P 500 going to be, what's the TSX going to end at in 2025. What we want to do is just talk a little bit more, what investors can kind of expect as we head into the new year.
Yeah, and I think based on everything that's gone out there in 2024 so far, I mean the landscape is changing, and my message has been to expect the unexpected. And I think trying to predict exactly what's going to happen, exactly how things are going to play out, very, very difficult to do, and probably not a smart thing to do, right? So my crystal ball is no clearer than the next person's, but we can give you an idea of our process, how we manage money, how we look at things like risk indicators, how that all ties in with the broader landscape here. So certainly looking forward to diving into that today with you.
Yeah, so one topic that we talked a lot about in 2024 was obviously the lead up to the election, but now we know the results of the election. So just kind of want to get your take on what that could potentially mean for markets.
I mean, look, this just creates a lot more uncertainty out there based on what went on, and I think it's necessarily a bad thing. I don't think it's necessarily a bad thing. I don't think it's also necessarily a good thing based on the political landscape in the U.S. Changing. We just don't know. I think it's certainly much more of a wild card situation because the overall outlook and the landscape has changed now. So look, the change in the political landscape, it creates a lot more uncertainty. I think it's going to create a lot more uncertainty in the news cycle. And we sort of knew what we were getting over the last 4 years when it came to policy. And I think you're going to see something that is probably similar to what we had in the last Trump and Republican term from 2016 to 2020. But there's a number of areas there where it's just more unknowns, more uncertainty can create volatility in markets. Whether it's things like foreign policy, whether it's trade policy, and that relates to Canada. I think it creates more potential for geopolitical uncertainty for sure. That being said, like we're neutral on the political front. Really, what we care about is how that relates to your money, your wealth, the markets, your investments. And you look at the last couple of terms out there, or last couple 4-year terms, the returns were almost identical, right? One was Republican term, one was a Democratic term. So I don't think it really matters so much at the end of the day for stock market returns, but I do think you're going to see a more uncertain, a more volatile environment. And we even saw that right after the election where the markets bounced up. I mean, frankly, we've been getting more negative red light type signals out of the market through November. That drives our process, but that really doesn't have to do with the political spectrum or who's in office. It has to do with market behavior being overbought, overextended, having run too far, too fast, and that's ultimately driving our decisions.
Yeah, it's interesting. So if you look at the last two terms, the returns have been very similar, but I think what's even going to be ramped up more, and we've seen it really over the last 5 years, is just volatility, and that just just doesn't mean volatility to the downside, but it also means volatility to the upside. So
Right.
all the more reason why you really just need to make sure you have a hands-on approach
Yeah.
to navigate that and kind of protect in the bad times, but also be opportunistic in the good times.
Yeah, and that's what it's very, very difficult, if not impossible, to predict where markets are going. And that's not, we're not trying to time anything. We're not trying to predict. What we're doing, we're responding to changing market conditions and changing risk levels and, shifting portfolios based on what's happening out there. And that's, when you have a more unpredictable environment, things are probably going to change faster, right? And the speed of change and shifts is probably going to accelerate. Some of that could be good, some of it's going to be bad. And we want to be ready for that and ready for anything, which is why I say, expect the unexpected, because if we sit here and say, well, the markets are going to go in this direction in 2025, and we've positioned everything accordingly, and they go the opposite way, that's not a great place to be. We want to go where markets are going, go with the flow, go with the trends and direction. And that's what a lot of our process, technical analysis, relative strength investing is about following trends.
Yeah, and a lot of money managers out there making these bold predictions at the end of the year. This is what's going to happen, and here's why. We talk about this. Our process, it's neither optimistic or pessimistic. It's realistic. So what we're going to do is just manage to the market.
Right, and so that's about listening to the signals that markets are giving us. And frankly, by the time we're putting this out there, the market may have changed and shifted. But as we look at things in sort of mid-November, the signals are to be more conservative, be more cautious, at least today. And that's because markets have had a really nice run up in 2024.
Yep.
Even coming out of the election, they had a really nice run up. Things are changing. Some of the policies are changing. They're moving towards more inflationary policies, which could change the whole interest rate story and the narrative there as well. So if inflation starts to creep back up in North America, in the U.S., in Canada, I mean, a lot of the policies that we're looking at coming down the pipeline, potentially inflationary for Canada, that might slow down the cycle of interest rates. So we don't know how central banks are going to respond to this. I mean, so far they've continued to show that they're accommodative and are looking at easing and helping to stimulate the economy. But that might change. And I know anecdotally from talking to a lot of our clients, a lot of investors, a lot of the conversations we're having out there, a lot of investors are concerned and are preparing for some unexpected things to happen as we move forward.
Right, but the reality is we don't know, but we have the process to manage through that. One question I did have for you. So if you look over the last 3 years, so 2022, 2023, 2024, there's been so much talk about interest rates and inflation driving the market. We had interest rates going up, we had inflation going up, and then we had it coming down, and there's a lot of talk about that. Do you think in 2025 the conversation will shift less from interest rates and inflation and kind of onto other things, or is that still going to be a driving force?
I don't think, Greg, that's going to go away. When you talk interest rates, inflation, I mean, the state of the economy as well is a huge one, and those are the big drivers that are ultimately moving markets. I think some of the drivers that are shifting the inflation story are shifting, and so that's going to come back into focus. Whether some of these policies are more inflationary, and whether we're going to see that ripple effect, and that might slow down that rate cutting cycle overall.
Right.
And there could be ripple and through into the economy, because we never really saw any sort of recession. We never really saw any sort of major downturn that happened. And basically, 2024 was a soft landing playing out from 2022, and that was a lot of 2023 as well. But usually these market events happen every few years. I mean, we had think of the last three that we had. We had a 2018, a 2020, and a 2022. Pretty major market events where 20 to 30% declines in the market. So, not saying that is going to happen in 2025, but situations are setting up that there may be some kind of pullback, correction, reset that happens in markets. And frankly, we're expecting the unexpected. With our process, with our strategy, we want to be ready for anything.
Yeah, and when you look, again, we're not sitting here predicting there's going to be a big market crash or a big pullback, but more what we're saying is we want to be ready to make sure we're going to be able to navigate through that. So if you look at the last 10 years, 2015, the S&P 500 was negative. 2018, it was also negative. 2022, it was also negative. So it has been a few years, and just what you said, Will, it's not uncommon for every few years to get kind of a big pullback and correction. So again, not sitting here saying we think it's going to happen, but more we just want to make sure we have a process to work through it.
Right, and that's what technical analysis is really about. It's about listening to the heartbeat of the market and separating the signal from the noise when it comes to the market. And so a lot of the talk you hear about what's going on here, what's going on there, that's just a lot of noise that tends to come in. And like everybody's got an opinion. There's lots of opinions that are overly optimistic, just way too optimistic about where things are headed, and you'll never hear any sort of negative thing said about the markets or the economy. There's lots of the traditional hedge fund guys that are just way too negative as well,
Right.
and they're pushing a narrative that's going to prop up their fund, and it's market's going down, sell everything. I don't think that's the right message either. I mean, our message is one that's grounded in reality and is grounded in what the markets are actually doing, and we're listening, we're watching the markets on a day-to-day basis to see those signals. It's are they overbought and overextended? Are they oversold and are they washed out? What's the trend? Have trend lines broken, right? What sectors are in strength? What positions are in strength? What are those more favorable pockets of the market? And most of the time, markets do go up.
Yeah.
So 70-80% of the time. So to be honest, that more optimistic message is, if you were going to pick one, optimistic, pessimist, I'd honestly pick that optimistic message, because more times than not, that's right. The pessimists that are out there, the negative people are they're right, but it's probably only 20-30% of the time. The optimists are right 70-80% of the time. What we're looking to do, though, is yes, we're optimistic, we're constructive about markets. We wouldn't be in the investment business, the wealth management business, if we weren't. But we also want to be realistic, that we know there are going to be times when markets go down. There's pullbacks, there's crashes, there's corrections that happen. We want to be ready for anything. We want to expect the unexpected, and we want to change and shift and adapt based on changing market conditions, not on some big sweeping projection or prediction of what's going to happen in markets, but what's actually happening out there. And what we've seen, really, I would say since about October 31st, through November so far, markets got really overbought, overextended, have run very far, very fast over about a 3-4 months period, and are just starting to show some signs of weakness. So we take a more defensive stance in portfolios to protect and preserve capital and keep things safe in that sort of environment.
Yeah, and that's also the nice thing about technical analysis, is that we're looking underneath the hood of the market and seeing what's going on, what's overbought, what's oversold. So we're not making a big prediction. We're just looking at reality and looking at what's actually happening and making our investment decisions based off of that, not just something that we think or prediction.
Yeah, and that to me is what ultimately leads to the best results, is being grounded in the reality of the situation. And look, the reality, at least right now, is markets have been quite good since late 2022. So through 2023, through 2024, at least so far, no major crashes, no major corrections. But the speed and the pace of the markets, these days, those usually happen every 2-3 years, right? And so at some point, there's going to be a major market event. And I would look at your portfolio, I would look at your plan, I would talk to your advisor and ask, what's your plan for the next bear market? What's your plan for the next major crash and major correction, and how are we going to navigate through this? Because at Aretec, we have a plan, we have a strategy, we have a process for navigating and carrying clients through that. And unfortunately, I think a lot of advisors and portfolio managers, their plan is just ride it up, ride it down, and that can work. If it's a minor blip, that probably worked pretty well, right? But you look at the more major market events, the deeper the crash, the deeper correction, you go back to 08, 09, you're talking about a 3 to 5 year window in terms of getting back to a break-even point and a recovery in terms of your capital. Look, I hope that sort of event, that sort of financial crisis doesn't happen, but very, very smart investors are ready for that, right? They can take advantage of that. They can be opportunistic. They thrive in the bad times, right? It's not just the good times, it's the bad times that you can thrive, be opportunistic, and take advantage of it. And you need to have cash, you need to have defensive assets to not only weather through that, but to capitalize and basically be opportunistic in those type of market environments. And that's a lot of what our process is about. So I don't know when that's going to happen. I hope it's not for another 10 years for everybody's sake and the market keeps going up. The reality is at some point there's probably will be some sort of major market event. And I don't know if it's politics. I don't know if it's geopolitics. I don't know if it's interest rates, inflation. I don't know if it's some other pandemic. I don't know if the economy just starts to crash. No, nobody knows. That's the reality. But that's why we watch, we listen to markets, we watch indicators, because the market gives us signals, right? It's a massive voting mechanism. Investors are placing their bets. They're putting their money where their mouth is. When you watch the talking heads on TV, they're just giving you their opinion, right? It's not necessarily their financial bet. It's just them trying to tell you a story. But when you look at markets, that's like looking at probabilities. It's looking at odds. It's looking at real investor behavior, and it's looking at supply and demand, which is ultimately what drives prices, which drive markets. It's a universal law, supply and demand, and having an understanding of that. That's what technical analysis is all about.
Yeah, and the other one thing I want to mention, so we talked about, in the last 10 years when there was a negative market, right? So we had 2018, we had 2022, we had 2015. But if you look, 2023, we had the Silicon Bank.
Yeah,
right?
That's another one.
And that was like, it was that year was positive, but we
Right.
had that crash in the middle. And then even in 2024, I think it was around the August long weekend, we had a little kind of flash crash. And even in 2020, the market still finished positive that year by, I think the S&P was up 20%, but we still had a 30% drawdown halfway through. So, it's not so much just looking at calendar years, it's looking at market events as well.
Yeah, and that was a nasty period in there where you had SVB, First
Right.
Republic, Credit Suisse, all of those. So look, that's what we don't really know where the risk is going to come from, and I think to try to sit here and say, this is where the risk is, or also this is what the market's going to do, that's wrong. But what we can and do is we watch, we manage, right? We listen to the markets, we listen to indicators, and those supply demand indicators, they will fire off far before anybody's actual opinion.
Yeah.
Or you hear someone on TV telling you do this or do that, and we manage to that, and that's what real risk management is about. That's what playing defense is all about. It gives us that ability to play offense and be opportunistic, because we are protecting and preserving capital through the bad times, and we can turn around and capitalize, be opportunistic, and make money in the good times.
Yeah, so you really need that ability to play both sides of the court, so to speak. You only can't be playing one way, because a lot of strategies, it's going to be pedal to the metal all the time, but that leaves you susceptible. But at the same time, there's other strategies, we talked about this, like hedge funds. They're constantly doom and gloom. They're constantly way too negative, and it doesn't give them the ability to play offense when the time is to be more constructive.
Yeah, and that's absolutely right. And I think that pedal to the metal strategy for our clients and our investors, it's not, it doesn't make sense, right? They've already made money. They're not trying to get double or triple the returns in the market. They want to keep their money safe. They want to preserve it. They want to protect it. And that's what our strategy is all about. So I would say again for 2024, expect the unexpected. I think we're going to see volatility. We're going to see uncertainty, both to the upside and the downside. And that's our message is, be ready for anything, expect the unexpected. And it's not there to be negative or fearful or anything like that, but just to be prepared, to be realistic, to be ready for anything. So, we're here working for you, your friends, family, colleagues, anyone that we might be able to help. We're happy to have a conversation. And remember that Aretec, we're here for Canadian families who don't want a good enough experience with their money, but an experience that's the best it can possibly be. We're here working for you. We want to help you realize your wealth. So, we'll be back with you next week. And thanks everybody for joining us, and we'll talk to you soon.